Hey, what's up, my friend? So, welcome back to this week's market analysis. I know, right? There wasn't a video last 1 or 2 weeks, right? Because I was away overseas in Japan, Okinawa, along the beach, cafes, and whatnot. So, I got back, I think, last week, around Monday or Tuesday. So, that was why there wasn't a weekly video. But the good news is I'm back. So yeah, let's continue where we left off. So in this week's video, I want to share with you three trades that I took right recently. So I'll share with you my thought process, right? Why I enter, right? I think this is a topic that a lot of traders want to find out. Why did we enter this trade? Why, right? So I'll talk about my thought process, the entries, stop loss, exits, and trade management, right? And finally, we'll discuss, right, the possible trading opportunities that I'm looking at this week and much more. Okay, so with that said, let's begin. Okay, so the first market that I want to cover is Euro against the Australian dollar. I believe this is a setup that I have mentioned, I think, 1 month back or so, right? Talking about it, right? And I took this trade and I want to share with you the thought process I had when I took this trade. So it's pretty straightforward. You can see that this market is clearly in an uptrend, right? If you are not sure whether you should be long or short, what I recommend you do is just pull out the 200 period moving average, this black line over here, and if the market is above this line, stay long, right? Means your bias should be to look for long setups. And if the price is below the 200 MA, your bias should be towards the short side. So this is a very simple filter, right? It is not 100% foolproof, but it will keep you on the right side of the market more often than not. So clearly you can see that, okay, the market is in an uptrend above the 200 MA. So where did the entry trigger come about, right? It came about at this tight consolidation over here. Think about this, right? What does this mean? You can see that clearly the market is above this previous high, right? So a lot of traders will look at this, oh, the market come back to the previous high, oh, previous resistance, right? Time to short this market, right? Because the market is at resistance, I should go short, put my stop loss above the high, right? So you can see that a lot of traders, I believe what they'll do is they see the market at the previous high, they go short, maybe there's a bearish shooting star, a bearish pin bar, they go short, stop loss above this high. Okay? And then what happened? The market stopped them out. I didn't do that. Why is that? Simple. Two reasons. Number one, I'm trading against the trend. If I want to trade against the trend, then the second thing that I will look for is a strong price rejection. Clearly, none of that has happened. So instead, I was looking to go long because I look at this and I notice that there is a tight consolidation above this previous high. This to me is a sign of strength. Because if you think about this, if the market is at resistance and is still holding up over there, what's it telling you? It tells you two things. Number one, either the buyers are willing to buy at these higher prices, or number two, the sellers, right, are weak and they are unable to push price lower. One of them, right? And it doesn't really matter which reason it is. We'll never know. But what we can all agree on is that it's a sign of strength because the market refused to trade lower. It's been holding up. And if you think about this, if traders are consistently shorting at this resistance, where would they put their stop loss? Chances are it's above this highs, above this highs. And what happens if the market trades above these highs? This cluster of stop loss will be triggered, right? So if your orders, right, you are short and you have a stop loss, what order is it? It's a buy order, right, to get you off the trade. And if there's enough traders, enough orders getting triggered, these buy orders would fuel into bullish momentum. And this is where I got long. So when the market basically breaks above the highs, right, triggering this cluster of stops, when it breaks above the highs is where I got long. I had my stop loss of 1 ATR below this low, I believe somewhere over here, and I got long. Market went in my favor and then traded against me. Okay, did I bail out? Not just yet, because I had a plan to follow. I had a trailing stop loss that I was following. Was it easy to handle it? Well, if you have a plan, if you're risking a fraction of your trading capital, right, it's pretty much, the cost of doing business, right? It's the fact of trading that the market doesn't go in one straight line. It goes up against, it goes in your favor, it goes against you, and etc. So where did I, trail my stop loss, right? It's not rocket science, it's just very simple technique, right? I was looking at the weekly time frame and I noticed that the market, over the last few weeks, it has not break and close below the previous week low. So I got long somewhere over here. And I noticed that, for the last 3 or 4 weeks, it has not actually break and close below the previous week low. So I had my stop loss somewhere around here. So my plan was that if the market were to break and close below the prior week low, I would exit the trade. Well, that didn't happen, and in this case, the market did reverse back in my favor. All right, it retraced against me, went back in my favor, and I'm still holding on to this trade. So again, the thought process is, I think, is pretty straightforward. How I'm trailing my stop on this is that, I'm just trailing on the previous week low. So clearly you can see that the previous week low is now at this level over here. So if this week, right, let's say it breaks and closes below this low, I'll be out of the trade. It could still turn out to be a losing trade. That is possible, right? And that is really, right, the nature of trading, the nature of trend following. This is, some of you would call it a trend following, right? Depending, how you want to look at it. So this is the nature of trading. If you want to, right trends in the market, you have to accept the fact that you can see winners become losers. Okay, if you can't handle it, then perhaps you may want to consider other type of trading techniques like, swing trading, where you take profits at, obvious highs and lows, swing highs and swing lows in the market. Okay, so this is a Euro Aussie trade that I took. Right, moving on, another one. So this trade, dollar Sing, is actually taken quite some time back, but I want to share with you anyway. There's a lesson behind it. Okay, so dollar Sing, you can see that this one over here, right, the market broke below this area of support. Right, and I was looking to go short, and I didn't catch this move. Right, the only time I went short was when the market formed this price rejection over here, this small bodied red candle. Let me just zoom in a little. Right, you can see this candle over here. I went short again, stop loss 180 above this highs, and this trade I got stopped out. And the thing is, right, again, right, I made a mistake of trading this price rejection, because again, if you look at it, the candle size is relatively small. I shouldn't have traded it, right? And even if I did want to trade it, I should have go down to the lower time frame, right? And to watch to see that the buyers are getting weak before entering the trade. So this one was, if you ask me, is a poor trade, because I shouldn't have traded this, as the price rejection is relatively small compared to the earlier move. Okay, so what I should have done is, again, let me just just share with you a little bit, right, what I would have preferred, right? So let's say this candle over here, this green line, right? So I go down to the 4-hour time frame. Okay, so it's somewhere around here. Okay, so this 4-hour time frame, you can see that this is the same green line you saw earlier, right? This is where the move stopped me out of the trade. So preferably, right, since that was a small price rejection on the daily time frame, what I would have to see is to see weakness by the buyer. So this small body candles come up, couldn't rally further, and then when it trades below this swing low, I go short. I would say that is a more so-called quote-unquote safer way to enter the trade, right? So that is what I should have done, right? But again, this is a losing trade, no point harping over it, right? But I just thought that I would like to share with you, right, this particular trade that you want to see the price rejection, right? How aggressive it is, right? Before taking such trading setups. Okay, so this for dollar Sing, and moving on, another trade, right? Euro Pound. Okay, basically the same concept which what I just shared earlier on the dollar Sing. So this trade, look at it, right? Price has come into this area of resistance. So if you ask me, right, it is not wrong, right? If you were to go short at this level over here, when the market break and close below this low, right? There is a possibility that it's forming a build up at this area of resistance. There is a possibility, but if you look at it, right, the trend is somewhat in the range. You're not trading against the trend. So if you ask me, right, I would say it warrants an opportunity to go short, since you're not really trading against the trend, and the market has showed you, right, multiple price rejection at the highs. Okay, so I didn't trade this exact setup. What I did was that I went down to the lower time frame, like the 4-hour time frame, to so-called confirm my buyers that the market is unable to rally higher. So how did the pattern form? It was something like this, right? This over here, right, was the price rejection you saw on the daily time frame. On the 4-hour time frame, I want to see that the buyers are unable to push price higher, and I see it in the form of this bearish flag pattern over here, right? I just covered about flag patterns in the recent YouTube videos. If you didn't get it, right, just look through my YouTube page, and it's one of the most recent videos. So you can see that over here. Okay, notice the size of the candles are relatively small. What is it telling you? It's telling you that the buyers are unable to push price higher. Because previously you look like, they have no issue just pushing price higher, pushing price higher, pushing price higher. The range of the candles are relatively large. But when it comes to this point over here, right, the range somehow has shrunk. So this tells me that, the buyers, they are getting weak, unable to push price higher. And I want to short if the market can break below this low over here, this swing low. Right, and on top of it, right, we have the market at this area of resistance on the higher time frame. Okay, so that's what I did, right? Again, stop loss, I typically like to set it 1 ATR above the highs to give it some buffer, or 1 ATR above this high, so like somewhere here, to give it some buffer. And this trade, fortunate enough for me, right, it did went in my favor. How did I trail my stop loss? Again, no rocket science, right? Just I look at the previous day high, right, and I tell myself, if the market breaks and close above the previous day high, I would exit the trade. So clearly this went all the way down, right, without breaking and closing above the prior day high. Okay, so I've exited this trade over here at this area of support. So now, in fact, if you ask me, right now there's actually an opportunity to go long. Why is that? Because if you look at this market is still in a range. You have a nice clean move into this area of support, and this price pattern over here, what does it tell you? It tells you that it has traded below this low, and then it got rejected and closed, slightly higher for the day. So traders who set their stops below this low clearly are stopped out already. And the fact that it closed higher, to me, this is a valid form of a false break, where it's a false breakup. Okay, and I went long on this trade, and the stop loss again, right, is just a 1 ATR below this low somewhere here. Okay, so this is a trade on Euro Pound that I took, right? Still leaves much to see whether it will go against me or in my favor, right? But whatever the case is, I have a plan to exit my trade even if it goes against me. So one thing to bear in mind is that this is not any trade recommendation whatsoever, right? Please do your own due diligence before following my trade calls or whatsoever you want to call it. Okay, so this is for Euro Pound, and another setup that I'm possibly seeing is the dollar against the Chinese yuan. Okay, so just one last one before we conclude this week's video, right? So dollar against the Chinese yuan is also looking good, right? So clearly, again, what's the trend? The trend is towards the downside, right? If you just pull out the 200 MA, I can assure you the price is below the 200 MA, right? And if you just look at it, right, you can see a nice tight coil pattern, right, that is forming up over here. Volatility is shrinking at this point in time. So for those of you who have traded the markets for quite a while, you know that volatility is never constant. It moves from a period of low volatility, where the market goes from a period of low volatility, then it expands, then volatility will shrink, then it expands, and it might even go back in the opposite direction. So you can see this phenomenon happening on the dollar and the Chinese yuan, right? You see volatility shrink over here, then it expands slightly, shrink over here, expand, shrink, expand, shrink, expand. And where else? Right now it's potentially shrinking, and I would expect volatility to pick up once again. So for me, right, a valid setup to go short, right, if the market can break below this swing low, right, and I'll be inclined to go short the dollar against the Chinese yuan, right, and on top of it, you're trading along with the trend towards the downside. Okay, so this is a setup that I feel that is worth watching, right, the dollar against the Chinese yuan. And with that said, right, I have come to the end of this week's video. Just a quick recap, right? I shared with you 3 trades I took recently. The Euro Aussie, right, still in. Dollar Sing got stopped out, right, because I traded the small price rejection. Then Euro Pound, right, as well. Then I shared with you a couple of trading setups, the Euro Pound and the dollar against the Chinese yuan. Okay, so if you want to learn more about my trading approach, my trading methodology, right, you can go down to my website, tradingwithrayner.com, right? Just scroll down a little bit and download this ultimate trend following guide and the ultimate guide to price action trading. I assure you, right, once you download it, right, everything will be crystal clear as you have a firm foundation to how I trade the markets. And it's free, right? This guide. I'm not sure why some people say that you have to pay money for this guide. It's absolutely free, right? I've not even once charged a single cent for this guide. The closest thing that you have is I see people selling my books on eBay for 99 cents, which is quite a big insult, right? That happened, I think, last year or so. So it's absolutely free. Just go down to my website, tradingwithrayner.com. Download these guides. I'll send it to your email, and it'll help you get started on the right track. Okay, so with that said, I have come to the end of this week's video. Any feedback, comment, just let me know below, and I'll talk to you soon.